All right. Today we're talking about the story that's on everyone's mind, and that is the conflict in Iran. So, rising Iran tensions, aren't just a geopolitical story. They're a potential regime-defining macro event. And the transmission mechanism runs straight through energy, inflation, and then back to global policy. So Iran flanks the Straits of Hormuz, and that's the choke point for roughly 20% of global oil flows. Markets don't really need an actual disruption of oil flows. They just need credible risk. That's enough to disrupt things. So when you step back and look at it, I mean, oil is a macro input. It's not just a commodity. Higher crude prices are going to feed headline inflation. That's going to compress real income for people, and it's going to squeeze corporate margins on for companies. And when you have higher sustained energy prices, that produces a stagflationary mix of slower growth, stickier inflation, and that's exactly the type of combination that makes central bank policy harder to execute. So the critical question now is going to be, does higher oil delay the easing cycle that everyone is planning on here in 2026? If energy reaccelerates inflation expectations, central banks are going to stay restrictive longer than markets currently have priced in. And that shifts front end rates, potentially reshapes the yield curve. It'll potentially strengthen the dollar, and that'll drain emerging market capital flows. And that's not because demand is overheating, but because of supply side shock. And that's a fundamentally different macro dynamic than what markets are currently positioned for right now. So you can see what all the volatility in markets are about. So equities, in this scenario will face, margin compression. Energy producers are going to gain, but broader indices could potentially reset if earnings expectations, fail to hit the lofty goals that markets have set for them. Fixed income, on the other hand, that's going to become a tug of war. You're going to have a growth slowdown that will support bonds. Inflation persistence is going to pressure yields. The dollar is going to strengthen, tightening global liquidity, and energy importing emerging markets are going to get hit on two fronts: capital outflows and deteriorating trade balances there. So not good for the emerging markets. We're seeing a lot of pressure on them today as we film this, actually. So the core question is whether this stays a volatility event, which we're seeing in markets, or becomes a structural supply shock. We're just going to have to see how it plays out. Because if it's contained, markets are going to stabilize, right? If it escalates, we're looking at repriced inflation floors, higher neutral rate assumptions for central banks, and a prolonged global easing delay. Markets are not going to like that. And that's a macro regime shift here we're talking about. So at this point, watch oil, watch inflation expectations, watch rate cut pricing, because the story isn't about geopolitics. It's about how energy risk rewrites, the global policy path at this point.